Hi, I'm Shanna Tomko. Today, I'm going to discuss retirement plan options available to the self-employed. There are a handful of retirement plan options available for the self-employed. In this video, we're going to cover two of the more common plans, the SEP IRA and the Solo 401k plan. Before we discuss SEP IRAs and Solo 401ks, you need to know the two different characteristics of retirement plans, traditional versus Roth. How retirement plans help you save and how they function for tax purposes depends upon these characteristics. With the traditional style plan, when you deposit money into your retirement account, also known as a contribution, you get an immediate tax deduction for it. For example, let's say you have $100,000 in net self-employment earnings. This is your business income after your business expenses. You decide to make a $10,000 deposit into your traditional style retirement account. Once you do this, your taxable income drops to $90,000. The theory behind the traditional retirement account is to shield income from taxation in your prime or higher earning years. When you contribute, you are shielding income from higher taxes now and shifting the tax liability to when you're retired and presumably in a lower tax bracket. For instance, if you are in the 35% bracket now, this $10,000 deposit into your retirement account means an instant tax savings of $3,500. When you reach retirement, your earned income drops and you are likely in a lower bracket. So, when you go to withdraw the funds at that time, let's say you're in the 15% bracket, and the tax you're paying on that $10K now is only $1,500. Let's contrast that with a Roth plan. With the Roth, you don't get a tax savings now, but you also never pay taxes again on that money. So to continue with the numbers in our previous example, let's say that you have the same $100,000 of net self-employment earnings and you deposit $10,000 into your Roth plan. In this scenario, you still pay income taxes on the full $100,000. So where's the benefit in that? The benefit is you never pay taxes on it again. So if throughout time, your investments turn that $10,000 into $1 million, that full $1 million is yours to keep. Not one single penny is taxable. In the traditional style plan, had that $10,000 grew into $1 million, some portion is going to be taxable. The real question here is, how much of that million is yours to keep? It could be that you fall into the 15% bracket, as our example suggested, and $150,000 ultimately goes to the government, or it could be something entirely different. Who knows what the tax rates will be when you retire? It's possible they're even higher. So to summarize, the beauty of the traditional plan is an immediate tax deduction on your contribution. The trade-off is you won't know how much tax you'll be paying when it's time to withdraw the money. For the Roth, no tax deduction now, but every penny in that account is yours to keep. Now that we know the differences between the traditional and Roth-style plans, let's return to the two most common options for the self-employed, the SEP IRA and the Solo 401k. The SEP IRA is a traditional style retirement plan that allows you to contribute up to 20% of your net self-employment income after a deduction for your self-employment taxes. Let's say you had $100,000 in net self-employment income. In this case, you would be allowed to deposit approximately $20,000 into a SEP IRA. Again, this deposit will immediately reduce your taxable income by the contribution amount. The great thing about the SEP plan is you have up to the due date of your return, including extensions, to open the account and make the contributions. This is one of the few tax savings you can take advantage of once the year is over. That makes for a great deduction. SEP IRAs are easy to maintain and have no annual reporting requirements. The other plan is a Solo 401k plan. This plan has many different names depending on the bank or brokerage house that holds the account. Other common names are the one-person 401k or the Uni-K. While both plans, the SEP and the Solo 401k, have the same maximum allowable contributions, With solo 401k plans, you can contribute more at lower income levels. The reason for this is the UniK is a combination of two different types of retirement plans, the SEP IRA and the 401k. This generates a higher allowable contribution. For instance, using that same $100,000 of net self-employment earnings, your contribution would be calculated as follows. First, you would be allowed to deposit roughly $20,000 for the SEP portion. Then, you would add to that $18,000, which is the 401k maximum allowable contribution in 2017 for the 401k component of the plan. So, on the same $100,000 of net earnings, you have increased your allowable deposit to $38,000. If your average tax rate is 35% and you choose a traditional style of retirement plan, the tax savings on the deposit would be $13,300. That's huge! With the solo 401k, you can also elect to designate your deposits as Roth contributions. So again, take no deduction now, but let all that money grow until retirement, tax-free forever. The one big caveat with UniKs is the plan must be established by December 31st. You still have until the due date of your return, including extensions, to fund the account, but the plan itself must be open by December 31st. If this type of plan sounds appealing to you, act now. It is not something you want to wait until December 31st to begin. Your broker or bank may not be able to accommodate the opening. Knowing deductions like these can save you thousands in taxes now or upon retirement. Thanks so much for joining me. Remember, a dollar saved is worth more than a dollar you need to earn. Consider your retirement planning options now to ensure your future is as profitable as your present.